That was really loud, wasn't it? Yeah, so I'm on record at the Surface Transportation Board as being soft-spoken, literally. So it's always good to have mic support. Okay, again, welcome everyone. So we're going to make assuming everyone's in agreement, we're going to make a slight adjustment to the schedule. Regent Rolfe and I have a meeting we need to attend at 11:30. So I need to be done by 11:15. Now, I think there's a passing chance that we actually might be done by 11:15 as I look at the agenda, but in case we're not, Regent Harrison Lee is going to take the lead and help us get to the finalization and the adjournment of the meeting. But towards that end, I think the item that we may take us the most discussion is the cost model. So assuming that everyone's in alignment, I'd like to do that first. I understand from consultation with staff that we don't require a motion to do that, to agenda change to one of our committees. So we won't do that, but I do want to make sure everyone's comfortable with that. And sorry to make you all wait and not be first out. And then we'll move as the agenda is more or less laid out, I think. So let me make sure I'm on the agenda. So does that sound good to everybody? All right, great. Then let's do the cost model and that. Oh, wait, first I got to talk about the minutes. So you have the minutes from 2 meetings actually in draft form. Are there any questions or comments about those minutes? Hearing none, I think we can deal with those in one motion. So is there a motion to approve those?
Mr. Chair,
So
I move
moved.
approval.
Thank you, Regent Harrison Lee.
Second.
Thank you, Regent Dicus. All without further discussion, and with approvals, aye, please. Aye.
Aye.
And those opposed. All right, thank you. Minutes pass. So give me a second here to get myself. Okay, so then that will take us to the as we just discussed, to the cost model, which is actually the first item of our discussion agenda, I believe.
Thank you, Mr. Chairman. So this is Elaine Frisbee, Vice President for Finance and Administration. I'd like to ask the members where they'd like to start. We've talked about the cost model at several meetings in the fall. So if we'd like to go straight to the scenarios, we could do that, or we could revisit some of the aspects of the cost model itself. What would be the committee's preference?
Regent Harrison Lee, any preference?
Yes, let's talk about the model, the scenarios that we've got.
Okay.
Okay with that, Regent Dicus?
Let me make sure.
That,
I think that makes sense. I mean, we did take time in 2 other meetings to go through the cost model after we acted in November as the regents to hold this until we got the recommendations back from TEA and from the legislative task force that was formed. So maybe I'll just quickly though for a couple of things. I'm sure we'll quickly move into tier, non-tier, and some of those discussions. You all recall that the tier is when there's extraordinary effort that's required to conduct a class, and then that sets up a different rate. Thus the word tiered, and then that has some impact on how the state funding flows, whether it's a tiered class or a non-tiered class.
All right.
And with that, then let's go to the scenarios.
All right. So what I have here, and as a reminder, there are 2 pages to each of these, and regents, those of you who are here have in front of you a copy of the PowerPoint, and in the back of the PowerPoint are the 8 slides of the different financing scenarios. So if you find that PowerPoint, you'll find that in the back. So there is an accompanying yellow striped page with a green striped page. The yellow pages simply have the technical courses, the tiered courses, while the green are the non-technical, what you might term the gen ed classes. For the typical output of our cost model, we generate what we call a gap report. Every year since the cost model was established back in 2011 with Senate Bill 143, we've never until this fiscal year had adequate funding to finance what the cost model has calculated as the college's expenses for tiered and non-tiered state aid. 2023 was the first year we had full funding. And so every year we would get the data, compare to the funding that we have in the current year, and we would have a gap. And that was the gap report. That is not the funding report. There is the gap report that just says, here's what the cost model says should be paid. And here is the funding for each of the colleges compared to the prior year. That is not the funding report, because for every year that we had the cost model, there were provisos attached to the funding line that would tell us how we must implement the cost model. And for most of those years, it simply said, never mind what the cost model said, generally give the college about the same amount as they got the prior year. Whether enrollment declined or increased, give them relatively the same amount proportionately to what they had the prior year. That was generally what we had going on. So this is the scenario one that you see here is the typical gap report. We take the calculations and compare them to the prior year. Where you see a negative red number would be a college that is overfunded according to the cost model relative to the expenses that are calculated. Where there is a black positive value, such as for Butler Community College on the third row, that is where there is a gap. So it kind of reads opposite of what you might expect.
Kind of.
Kind of.
I think it is counterintuitive.
It is
myself.
counterintuitive. So I always put that caveat. I always have to, you have to do a little backwards thinking there. So with that said, according to the cost model for tiered courses, under normal circumstances, if we were just told to completely adopt the cost model for next year, we would spend 3.7 million less than what we have funded in the budget right now for tiered courses. For the non-tiered gen ed courses, we would have a savings of almost 8.8 million.
Let me get this straight now that I'm new at this. So Allen County is asking for under the model would get 450,
Yes, so
but they're getting 1.3 million.
correct, according to the base, yes.
Okay.
So there's another aspect of this that we'll get to later about the overages and to what extent a college gets to retain those. And to be clear, the colleges simply recount to us the entirety of their student enrollments. And within our data system, then we go through all the machinations of aggregating all that information. So student X is an in-district at a community college. All the students at tech colleges are out district. Here's all the calculations. Here's all how it all shakes out. And this is the 450,000 for tech courses at Allen County is how the cost model calculates that. So this is very much a mathematical exercise. So that's scenario one, which is just the typical gap report. Scenario two then is the crux of what is before the board today, which is
It's really one of two things before the board, isn't it? Because we also had the smoothing.
there is the 3-year smoothing, correct? Sorry. The tier 6 was a vote just taken by the post-secondary tech ed authority, so it's top of mind for me. Scenario 2 is the same information as the first scenario, except for very certain courses, the most expensive courses in the cost model at what we call tier 6. Those courses, the information that we have for instructor salary data from the National Benchmark Institute told us that for 2022 data, the instructor rate piece of the cost model expenses would go down from 2021 rather than going up. And so the request was made to the Tech Ed Authority and will now be made to the Board of Regents to retain those tier 6 rates at the same level for the instructors as in 2021. And that is a $668,000 change in state aid when you compare scenario 1 to scenario 2. And this, of course, only affects the yellow striped pages. The green is, they're all the non-tiered courses. They're all the same rate, so there's no effect there. I'm going to stop there. Scenario 2.
I love it that you said of course, because I'm sure that was.
Okay.
obvious to everybody.
Okay. All right, so that's the $668,000 variation in scenario 2.
And again, this is recommend with is akin to being recommended to scenario 2, given the other group is already approved.
Yes, so the Post-Secondary Tech Ed Authority met back in February, late February, and voted to retain the instructor rates at the 21 level. And that's their recommendation to the board.
So at a high level and beyond the fact it raises it by the total amount you said, how much variation is there? I mean, I don't think it should affect the relative gaps here for anybody else to any large degree.
Well, it doesn't affect everyone equally or proportionately because it depends precisely at where are the tier 6 courses delivered,
Right.
where were they delivered? And some colleges offer more than others,
Okay.
if that's the
I
question.
understand it's not radically the same, but when I looked at it, it didn't seem, it was like it was strikingly different for a given, like in relation to each other, not
Yes.
obviously they all got more money by doing it.
Yes,
So, okay.
yes. So that is entirely an enrollment related calculation. That's scenario 2. And then scenario 3, then we get into the 3-year averaging of the cost model calculations. So in the past, up until now, we've done this on a single year basis. And last summer, it was the very end of August, there was an interim task force that met that included several legislators, and representatives of the community colleges, the technical colleges, and Dr. Flanders. And one of that recommendations from that task force was to switch from an annual separate calculation every year on its own, standing on its own, to do a 3-year rolling average to provide a smoothing effect, as you say. So to do then with scenario 2, then we model that forward to a 3 version where you take the 3 averages, compare that to the fiscal year 2023 base, and then you get a different gap report. And then there is one other, and this is with the tier 6 courses at the same rate as 21 for 22. And then there is another aspect, that last column with the 50% hold harmless provision. Last year's appropriation bill for the Board of Regents for tiered and non-tiered funding instituted a 3-year movement toward fully adopting the cost model. And they said, for the year that we're in now, 2023, colleges that are overfunded, Allen County always gets to be the example because they're alphabetically first, where they are $800,000 over. In the first year, they were able to retain that full amount of overage. The model covered all of it. This year, for the coming year, what we're doing calculations for, they would retain only half of the overage. And then subsequently for fiscal year 2025, then the plan would be no overage, you get what you get according to your re-enrollments. So you're fully adopting the cost model in that 3rd year, but you give them time to adapt. So that's the aspect of the final column there to the right. So this is the gap report with the tier 6 courses at the 21 instructor rate, with using a 3-year average of the calculations. And then at the very end, calculating for you then, what would the actual college funding be with that 50% hold harmless provision? So you see the impact there. So there is a slight savings relative to the current year. So if you look at the 3rd from right, the FY23 base, total 66, just over 66 million is what was funded in 23. With the 50% hold harmless, it's just a hair over 65 million. So just about $1 million less. So keep in mind enrollment, we're going to talk about this afternoon, but enrollments at community colleges have been on the decline for several years now. So that is the effect of scenario 3.
Which I think is worth saying, maybe it is stating the obvious. So this would be the combination of what would be all the input from other groups.
Correct.
So this is the legislature's action last year with the 50%. This is the post-secondary TEA recommendation on the tiered 6. And it is the 3-year average to smooth. That is the recommendation from the task force that was put together of all the representatives Elaine described earlier. So it is before us as to how we respond to these, but this is really the one that would reflect again all those inputs. And
Yes.
She's going to show us another one in a second, so we probably don't need to discuss that more, but I mean, I think they all have the virtue of being those inputs, and they also all, I think, pass the test of reasonableness that it's hard to recognize why instruction costs would go down year over year in this environment, and smoothing to help with funding. It seems to me to be a reasonable idea as well. But so this is again, I would call this one the leading scenario for all those reasons.
It's a very good summary. Thank you. All right.
They're supposed to be helpful upon occasion.
So the funding and the cost model go into effect in 25. So then if it's Allen County and everything stays the same, they would get another 923 in 25 to do
So-
use up their overfunding for the previous 3 years.
They would get whatever the cost model said at that point, so it probably wouldn't be the 923.
It would be more like 518,000, that 3-year average.
What would it? Wow, okay.
So then
So do
suddenly,
they get to keep that additional 404 that they,
They
not
get,
in future years.
they get it.
do they get to keep what they've had over the last 4 years where they built that up?
In their reserves, if they have, if they kept it as reserves, then yes, it's in the reserves, so we don't dip into what they've already received.
Not sending a bill.
Right. Don't pay us back. Correct.
Excuse me.
Yes.
But in some ways in 24, we are sending a bill or pay us back half what
Yes.
you've got.
Well,
Well,
no, it's not.
They
it's-
just don't get as
it's not-
much.
It's not.
Yeah.
Right.
It isn't in arrears. They just get 400,000 less than they were used to getting.
Right. I mean,
Mhm.
so it's still,
yes.
It's significant.
Still-
It's certainly significant.
because they could have been that much more overhead in reserves.
Yes. And
On the other hand, I mean, that's certainly true, and we need to be well aware of that. On the other hand, I mean, the legislator not acted last year, they actually would be out even more this year, and they would have been out all that amount last year also. By them basically transitioning in the cost model.
I think the idea from last legislative session was to give the colleges, several years to migrate toward full adoption. So they knew back in spring of last year that this was the plan. Now, of course, plans change. Legislatures change their mind.
Well. Not to say it in any way that it could even be close to objectionable, I hope. I mean, really, it was the 2011 bill set up using the cost model that would have suggested they should have got that around 500,000.
Yes.
And then last year, then it was an augmentation of that by saying now that we're fully implemented, we're going to transition into this.
Mhm.
So there was a change from the legislative perspective at that point
Yes.
as well.
The
Go ahead.
The other scenario then we have that is 4 is built off of 3 again. So the 3-year average, the instructor rates with the 50% hold harmless and the 3-year average, but then also incorporates a 5% what's been termed an inflationary adjustment for personnel costs across all of the colleges and all of the courses. For the tiered courses, that costs $3.1 million. This was a proposal from the colleges to the legislature this session, which this option here, the scenario 4, is what the House Higher Education Budget Committee has adopted as their recommendation for the budget, which the House Appropriations Committee has now also endorsed, at least as of last time I checked. They are meeting this morning and they are planning to meet tomorrow also to work on the 2024 budget. But as it came out of our budget committee, they were intent on doing the 3-year average with the tier 6 courses for instructor costs, the 50% hold harmless, and an additional 5% inflationary factor for personnel costs. And when you mold those all together, It actually would spend slightly more than what we have available in the budget. So to make everybody fit, we proportionately prorated everyone there on the far right-hand column to make it entirely spend down our appropriation for tiered funding, which is just over 66 million. And then on the non-tiered courses, 95.4 million. So that's how the four scenarios fit together, progressing from 1 up to 4. And I think Region ICE has properly characterized it. Scenario 3 is the one that is before the board today to incorporate the input from the parties.
But then, and this is just the way I think about it, which is only that, the way I think about it. So I think that's what we have to consider as it changes to methodology. Now, we have recommended inflation adjustment in the budget, so us taking the step of being okay with inflation adjustment, it would also be perfectly fine, but it's not really a methodology change. That's why I said what I said about scenario 3. So we can approve either really effectively, or some shockingly some hybrid of something that's not even before us if we felt like it, but yes.
With respect to these options, we now looked at four, right? 4 scenarios. The legislative committees are doing the same thing.
The House is, the
House
Senate.
committees.
The Senate has simply adopted the governor's budget, which does not, which to me, in my mind, the language that I've seen in the appropriation bill would carry forth the prior year's movement, 3-year movement to recentering and fully adopting the cost model for the coming year rather than, or the subsequent year rather than 24. So there, in my mind, the Senate version would look more like scenario 2, because they didn't really talk about the tier 6 instructor rates. So it will be seen yet how the budget conference committee comes out and what proviso they attach to these funding items. The only other permutation we've had on the House side, the House committee went so far as to change the appropriation bill so that every individual college's tiered and non-tiered appropriations would appear in our appropriation bill. So you would see an amount for Allen County Community College and Barton Community College. That has never been done before. Normally we just get an amount for tiered, an amount for non-tiered, and then we ask the board and the TEA to divide it up according to the proviso. The House Budget Committee went a little bit step farther and put every college's amount in the bill itself.
So they've made their judgment about which scenario and the specific dollars.
Yes, and they've gone with number 3.
So backing up, remind me
I'm
about
sorry, 4.
what's our task? Is our task just to understand this? I thought earlier
Well,
that, I'm sorry, go ahead.
well, no, please, what you thought earlier, what?
Well, I thought earlier that we had a judgment to make. But if the legislature is headed toward a conference committee where traditionally they'll make a decision, right?
Yes,
So what's our job?
Well, we could do nothing and let that happen. That's true. And maybe there's wisdom in that, but what we believe our judgment we at least should evaluate is, again, the tiered 6, technically what the legislature is doing isn't match the cost model because of the tiered 6 rates. And then we have the committee that was formed by the legislature, which included multiple legislators. President Flanders represented the Community and Technical College, and they recommended the 3-year smoothing. So I think it's probably fair to say we can't exactly change it since there's a statute, but I would say from my perspective, endorsing the recommendation from the task force, affirming the action taken by this post-secondary TEA makes sense. Now, the legislature could choose to ignore that. They could, they could then change the cost model officially or any of the above. But I think catching up with these recommendations, since this has been an issue of discussion this year, all the way to having a task force makes some sense. Now, I don't think, for the reasons we just stated, I don't think we necessarily have to weigh in on the 5%. That's why I was separating the two, because they're going to do what legislature is considering that that number now. And this is kind of a late ad for us to come back and say, here's a change to our legislative recommendation for one piece.
So what we decide will basically be advisory to the legislature, correct?
Well, advisory to the legislature, yes, but
That is to say,
it will ultimately depend on what action they do with our appropriation bill. And do they attach certain language that inhibits what the board can do or tells the board very specifically what to do in a scenario? And in which case, if that's what happens, then we would just ultimately, like we have every other year, come to you with, here are the numbers according to that proviso. So we're sort of in this in-between point where we don't know exactly how the budget is going to play out with that proviso language.
but the process would be, if we proceed with what we're doing,
Yes,
is providing them at least our opinion.
yes,
Here's our thoughts. And if you do nothing, here's where we're headed.
yes.
Yes, I mean, not to overcomplicate this, in part. On the other hand, we're finishing the process we started of saying we thought a task force was a good idea. The task force has made a recommendation that includes legislators. That then we would affirm that we were in alignment. So it's kind of an iterative process, as much as it's either or advisory or policy, I think.
I wasn't bringing that up to make a suggestion that it's not important about what we do
Oh.
and what our opinion is. It is very important. So
Oh, no, that was clear.
I understand, the gravity and the weight and the relevance of what we're doing. Thank you.
That was very clear. It was actually affirming the importance of our decision by making sure you were fully informed. So that's great. So any other questions or comments about this? And then would it be as simple as saying we would just endorse scenario 3 if we felt like doing that, or we need to be more detailed in our comment?
No, I think, I don't know if Regent Harrison Lee has. a
Oh, did you
question.
have a comment, Regent Harrison Lee? I'm sorry.
Thank you, Mr. Chair. And I appreciate your explanation of scenario 3 and somewhat of a consensus that, a collaborative effort around that scenario. And I guess my question is, coming out of this committee, are you looking for us to kind of recommend to the regents today that our support for, after having discussed this in the finance committee, is support for scenario 3?
Yes.
Okay. Action, or you're looking just for a consensus here?
I'm not sure, because typically we just get consensus and then we present it to the board for action. So I think we're just looking for consensus.
Okay.
And it's probably a consensus that's hard to summarize for the conflict. But again, effectively that we're aligned with the idea of scenario 3 that reflects the inputs from the various groups as we described. And then again, scenario 4 that puts inflation in, that's not something that is foreign to us, but not really something before us, given where the process of the legislature is.
Okay. All right. Thank you.
By the way, just to tag on a final comment about the discussion that I brought up. I think it's important that we do take a position. We take a clear position that is supportive of better, higher quality education. I think that's consistent with our role, our leadership role in post-secondary education. So by asking the questions I was asking, it's not at all minimized. In fact, it's the opposite. I think we should be very clear about that we are supportive of higher quality post-secondary education wherever it occurs.
Thank you. Great. So mechanically what will happen here is this is on the discussion agenda. We moved it up so we should cover it since it's on the discussion agenda. So we'll have a specific time present and we'll do some shorter version of this to the whole board with an understanding that we've gone through it actually across 4 different meetings now. And everything we just said in terms of what we endorse. So if everybody's okay with that. You okay, Regent Dicus? Okay.
Thank you. Adjustment, if we don't endorse scenario 4, would that be sending a message to them that we don't think that 5% adjustment for personnel in this inflationary period is needed? Or,
That would not be our intention. So we need to be clear about that. I mean, again, we put inflation in our recommendations, our recommended budget last November. So I think it would be consistent with that. But again,
I mean,
we're,
I'm comfortable either way. I just don't know what kind of message that sends if you go with 3 versus 4, and that's the only
What-
differential between the two.
I think in practice, what we'll do, I think the actual motion, Elaine will clean me up here in a second, what Carl meant to say, would actually be that we adjust the tier 6 rates and we take the 3-year smoothing out. So we really won't say scenario 3 or scenario 4. We'll say those two things. Those are the enduring steps to the changing in the cost model. And then the legislature is already running with effectively what is scenario 4.
Okay.
Although they actually may be a little higher than scenario 4 because they just outrun the cost model at the moment. So what they do may not bear resemblance to any of, it bear resemblance, it may not be exactly it may not be even exactly scenario 4.
It's scenario 5.
Yeah. So again, I think if we do it that way and we make a motion that are those two things, then we really, and I think if asked, we could very candidly say, well, we're doing, because of the circumstances, we're doing this at a time that they're already well considering a scenario that includes inflation, which we endorse. So. Okay, all right. Okay, wonderful. All right, thanks, everybody. Thanks for taking this one first. All right, then you want to go back to the agenda as previously described, right?
So I think next would be Jim McMurray.
Morning, Mr. Chair, members of the committee. My name is Jim McMurray. I'm with the Kansas Development Finance Authority. Been with the authority for around 17 years. And during that time frame, I've published the annual Kansas debt study, which will pull some statistics specific to the region's institutions for you today. And I see that we have a short slide deck up now.
So thank you for being here and appreciate your patience and waiting for us to grind through the cost model.
Oh, I certainly understand that. It's my dubious pleasure to try to talk about borrowing in front of some veteran bankers. So we'll see how I do.
So we made you wait a while. Since it's basketball season, we iced the shooter, but anyway, but okay.
So short slide deck for some market context, which may not be news for some of you, but maybe others. Rewinding the clock for around 2 or 3 years. Of course, we had the pandemic, and part of the response to the pandemic was to put forth a very large amount of fiscal and monetary stimulus, which with the benefit of hindsight, we can see is probably lit off inflation. The Federal Reserve initially thought that inflation was going to be transitory, and then pivoted to increasing the Fed funds rate 4.25% so far, and they'll have another announcement this afternoon of what they intend to do. This has resulted in long maturity bonds taking an absolute beating last calendar year, with the Bloomberg U.S. Aggregate Government Treasury Long Index down 29.26%, which actually outpaced the decline in the S&P 500. We've seen within the last 2 weeks, this has caused some problems with banks, especially if they're not well matched up with their asset liability profile. Closer to home, the economic benefit of doing refundings with many of your border regions debt transactions. The economics of those have been significantly reduced, if not totally eliminated at this point. The market is open and available for access. Kansas State Athletics went into the market with a $45 million transaction on March 14th, received 7 bids. And the Moody's rating was A1, and the best bid on a TIC basis was 4.26. So the all-inclusive cost was 4.32%, and the weighted average maturity of the bond offering was 16.3 years. The table I have for rates and ratios is still, even though it was market close on Monday. Yesterday, Treasury's 5-year went up 0.17, 10-year 0.12, and the 30-year 0.08. So Treasury market's been bouncing around a lot. And in the table, the second column group captioned MMD, that's municipal market data. That's a index rates for tax exempt debt, high quality tax exempt debt. So you can see the relative value of borrowing taxable versus tax exempt, and you can see that by the lower yields compared to Treasury rates. Moving on to the next slide is data pulled from the Kansas debt study, and I've combined the 6 state universities debt load reaching back to 2005 to 2022, showing annual balances with an annual change and then an annualized increase at the bottom of the table or below the table. You can see that the universities were very lightly leveraged back in 2005 timeframe, and that was substantially led to a lot of growth through 2016, where annualized growth was around 15.4%. And since that time frame, university debt in aggregate is down around 13%. So leveraged up over a decade and have stabilized for the last half decade plus. The next column group with the fall FTE enrollment, you can see has been generally level over the full spectrum and declining in the recent years, which is not news to you, of course. And then to put some context behind those numbers, I did debt per FTE, which started around a little under $5,000 and ramped up to around $20,000 per FTE. And then for final context, I put the Kansas GDP numbers in the final column group set. You can see the Kansas GDP's grown at an annualized rate of a little over 4% for the last decade and a half. Continuing to narrow in, yes, Regent Dicus.
Is there ever can you go back to the previous slide? Yeah, when you look at the debt to the FTE, is there a number that it becomes worrisome? I mean, when you go in the time frame you've given us from 4785 to, as high as 21.8.
I think you would have to burrow down to a particular institution. In this case, this is more of a macro picture. The big thing would be the trend that existed from 2005 to 2016. That we can't do that again. I mean, you can't go through a decade period where you're quadrupling your amount of debt. So, 2005, it was lightly, the institutions were lightly leveraged. So I think, the growth that in debt that occurred, that can't be repeated, quite honestly. I mean, you're probably much more moderately leveraged at this point, moderately being middle rather than lightly. So putting on more leverage at this point beyond what you're amortizing or actually need to replace at this point, it's probably a heavier lift than it was, 10, 15 years ago. Okay, burrowing down a little bit down to the institutions, we preferentially use Moody's Investor Services for our credit ratings. That under note 3, you can see a little explanation there, but historically the S&P methodology is less favorable than the Moody's methodology. And also we're not able to negotiate as well commercially with S&P. They seem to be pretty stuck on, not coming off their price points, and also more importantly, their annualized annual surveillance costs. So, and the market really hasn't dictated the need for 2 ratings. So a little busy on the slide. Maybe you want to focus upper right on current ratings. I have the 6 institutions, and then some of the institutions have credits that are not general to the institution. For example, if you go to Kansas State, you can see Kansas State Athletics, and then also Kansas State Olathe, which is their Olathe Innovation Campus. You may note different tiers of Moody's rating there. AA3 for the university, A1 for athletics, and then actually a higher rating, AA2 for the Olathe Innovation Campus. The reason for that particular anomaly would be the debt for the Kansas State Olathe Innovation Campus is based on a Johnson County Educational Research Triangle Authority credit, which is a slice of Johnson County's sales tax. So you can imagine the credit strength of Johnson County comes in a lot more play there in that credit conclusion rather than, a typical general university pledge. On the left-hand side of the slide, I've highlighted the Moody's Investor Services Rating Scorecard. It's pretty formulaic. 70% of the scorecard is straight quantitative metrics. And the overriding theme that you can discern if you dig into that, I've got the full methodology here, more than happy to share it with you, is size matters. Starting at the top, 15% of the scorecard is just on the sheer size of the enterprise based on annual adjusted operating revenue. And then further down under the financial resources and liquidity and leverage and coverage, you can see the total cash and investments, which is generally correlates with the size of the enterprise, factors into another 30% of the scorecard. So that's one of the reasons why you see our larger institutions have higher ratings on the credit spectrum. And then also of note, 30% of those scorecards are subjective or qualitative matters, brand and strategic positioning, operating environment, and then financial policy and strategy. More than happy to burrow down on any of those on an institution level or scorecard level. And then finally in the center, you can just see the whole spectrum of Moody's ratings going all the way from AAA to C, which a credit would be in default at that point. On this slide, we go through the scorecard with the specific measurements on each of the 6 institutions. 5 of the institutions had credit assessments or credit opinions issued in 2022. University of Kansas was last issued a scorecard in the spring of 2021. So I expect Moody's will be calling. Jeff, so they've already called. Okay. Hit their periodicity requirements and just maintain an update. Of course, the issuer or the borrower is not just the client to the rating agencies, the investors are too. So they need to maintain some frequency and update. Again, you see the individual scores for all those metrics, including the subjective ones. I would say across the board, most of the metrics for the institutions are somewhat stronger than the qualitative measures. The qualitative measures you'll see, for example, brand and strategic positioning for the smaller institutions are in the B, AA level. And historically, before this methodology got revised to where is today, the quantitative measures they used to use, which now essentially a qualitative measure would be acceptance rate and annual growth in revenue. So the signal there is, these smaller institutions do not have a very deep market, and they're accepting a lot of, almost all the applicants into them. So when other institutions are able to pull those, prospective demand away, or demand just gets softer in general, they're going to feel more of the impact of that than a larger institution will. Then my final slide before we go to Q&A is just, some thoughts on capacity. I think a lot of times people want to know what a debt capacity is, and it's a little bit, deeper conversation than it's just spitting out a number. I would point out there are no statutory limits for the incurrence of debt. There's no KBOR policy limits. You push it down to the universities to see if they want to self-establish a limit. And the existing statutory and KBOR policy framework is mostly centered around just the approval process. And we suggest that as part of your approval process, you ask the universities to include in, for example, their position paper, or when they have the discussion with you, to ask them to, go ahead and give you the debt burden ratio, the average debt service coverage, and the viability ratio. Those are ratios that are already established in your policy manual. And then getting back to what I started off with saying is any kind of capacity analysis, by its very nature of spitting out a number, you're making a great deal of assumptions in terms of how you structure the new debt, what kind of amortization it has, what its cost is, and plus it is, you're going to make some kind of assumption of what your limit is. And we don't want to make that on behalf of the institutions or KBOR. You need to tell us what your limits are if we are to do a capacity study for you. And we're more than happy to do that anytime you request that, and can give us the inputs that we need to make a reasonable calculation. That's the extent of my prepared remarks. I'd be more than happy to answer any questions.
Good, thank you for this. Just picking up on your last comment or offer to provide us some more analysis. What would that entail, and how difficult would that be? And more importantly, what would the output be? What would we be able to see if we asked you all to do that?
And we would probably need to have a 30-minute to hour-long discussion about, what assumptions do you want to have us make in preparing that calculation. We've got the numbers on the existing debt and what the terms and conditions of that, but we need to, define what constraints you want in terms of what is the limit. What is it? An absolute dollar amount? Is it a certain amount of coverage, or whatever? And then we have to build in a bunch of assumptions in terms of what's the structure of the debt you're going to layer on. Is it just going to go flat on your existing profile and you're more likely to hit a constraint sooner, or are you going to wrap it around your existing debt profile to give yourself more room? So, we could probably have that discussion in an hour or two, or excuse me, a half hour to hour. And then maybe a little bit longer if you want to entertain multiple scenarios in terms of, okay, well, this is one assumption set, or, let's look at, option 2 or option 3, tweak the assumptions a bit. And we could probably turn that around within 2 weeks.
Thank you. Do you have any, one more question, Mr. Chair?
Sure.
Do you have any knowledge about the way other states work with respect to the existence of policy? I noted that we do not have a board level policy with respect to this matter. And then that, some people would say that's a little concerning. If we're the board of directors and we have 6 different institutions that are subsidiaries, then most risk analysis in banking would say you better know what you better have a parent, a holding company kind of analysis.
Right.
Do you have any knowledge about or experience with the extent to
Yeah.
which
We-
other states
we-
have overarching policies?
Right. Occasionally, and we have experience in this other programmatic areas. There's 50 states, and there's just literally dozens of ways of doing this. And each state kind of makes its own decision. What I've seen when I've gone out and surveyed the landscape is smaller states just don't have the manpower or, to do as many things in terms of governance and control, and just, hey, they're just getting stuff done, and if it's not broken, they're not going to fix it. And we're probably closer to that end of the spectrum versus like the state of California, which has, and Texas, they have very strong and large regions, institutions, university systems or multiple university systems, and have come across these issues sooner in their life cycle than we have, and do have policies. Generally, it would be a credit positive to have it, but you also have to offset that with if it's overly constraining and doesn't let management make the decisions that they need to make to run their enterprise. So, there is a give take on.
Thank you.
Well, our grades are at a state that I would think that the premium reward for a little higher wouldn't be worth a lot.
Could be. And I think the signals I'm seeing out of the House Higher Education Budget Committee is the chair seems to be kind of focused on that issue right now. A cap or some perhaps exerting more control over the issuance of debt on the legislative side, where technically a lot of times in our process we encourage to receive, have a authorization in an appropriation bill. That's not required. I mean, that's power is in you as a board of regents to supervise the incurrence of debt.
Any other questions? All right, well, thanks for your time. Good presentation. Ethan, all right, Ethan.
Good morning, committee. While the slide deck's getting pulled up, just wanted to point out for my business colleagues, I did not bring any tokens of appreciation this month, so.
It would have been bold to do it again the last time.
Thank you for letting us give a little update on our financial condition for the institution. I'll start out a little bit with just kind of talking about some of our key strategic initiatives that we've got in play right now. This isn't certainly all a comprehensive list, but some of the major ones that we're focusing on, as well as some of the ones specifically within my portfolio. So strategic planning, we're under a comprehensive effort to develop a new strategic plan that will help guide us and develop new goals and objectives for the university. So that process is currently slated to be completed towards the end of summer, early fall. Once that's done, we will then pivot and take the results from that strategic plan and build it back into a robust campus master planning effort that we'll be undertaking. At the same time, we will also be looking at our budget model that we deploy at the institution. So some of you may know, we moved from sort of that incremental plus or minus, not based on any necessarily metrics in terms of how budget is allocated out, but to more of a performance-based model. So it's time for us to review that. But we also want to take time to look at, are we aligning how we're allocating our resources strategically with our new strategic plan? So we taking a look at that as well. We're also actively working on space management. Again, one of the primary goals here for the committee and the board. We've got several efforts ongoing right now with several of our colleges. And that then provides us an opportunity when that space is freed up from those colleges, we then can look at how do we relocate other departments and divest ourselves potentially of additional facilities that we have at the institution. So we're actively working on that planning right now. Capital renewal, demolition, and of course our ag facilities, our big ag facilities project that we've got going on. All of our one-to-one match dollars are fully obligated, and we're actually actively working on $24 and might be a little presumptuous at this point that we're hoping to get that appropriation, but we want to be ready. So when we get it, we can activate against those dollars when they come. And then obviously you'll see in some of the other slides, we've had an ongoing focus on student enrollment management, student success. And you'll see why here on the next slide, obviously, is our look at our fall FTE residency. Again, you can see since 2013, we've continued to decline over time. At this point, we're about 5,000 FTE below where we were in 2013. During that period of time, as we've reduced students, we've obviously then received or generated less tuition revenue. And so we've been actively managing and adjusting our budget accordingly to the tune of about $65 million has been pulled out of our general use operating budget in recognition of our enrollment decline. So you'll look at some of the financial indexes later, but you can kind of see we're actively managing accordingly to within our reduced resources. But we have good news. Our fall 23 applications and admits for the university are up about 12%. For the Manhattan campus specifically, we're about 2% up on in-state enrollments, applications and admits from the prior fall, and about 19% in our out-of-state. So we're really excited about our out-of-state pricing strategy that you all approved earlier this year. We believe we're starting to see some real impacts on there. Of course, we have to yield those students. We have to yield them to get them to enroll. And one of the markers that we use to determine whether we're going to yield is our housing deposits. And we're up about 5.6% on our housing deposits at this point, year over year. So we're excited for what we believe is our SIM efforts have started to produce. Again, another just look at our student credit hour production obviously follows our enrollment. So you're seeing a decline there. 2021 obviously is the pandemic where we pivoted and taught a lot of our courses online. But you see even in 22, even though we've kind of returned to normal operations, we've actually still increased our overall production of online credit hour. So that's a good recognition of where the market has kind of pivoted post-pandemic. Just a quick look at our undergraduate resident tuition and fees. So again, this is just a calculation based on 15 credit hours and all mandatory fees. Does not include any sort of program or departmental or college fee in this information. That's a little difficult to make that apples to apples comparison. So we just look at our published tuition and we looked at the mandatory fees from the rates. We're about the fourth lowest based on looking at our 2025 peer set.
And this is the present.
This is present. Yep. Mm-hmm. Yep. Yep.
Would the other institutions you're comparing to back out those fees too, or is this?
We build this ourselves. So we go look at their comprehensive fee schedules. Just a quick look then at, I know we're in March, but we'll spring back to pretend we're back in December. Do you have to
I'm
go?
sorry I
You're fine.
interrupted your transition, but I probably a good moment for me to go. So
Absolutely.
sorry, I won't see the rest of your presentations. Thank you all for doing those. And just so you all know from our previous meeting, as well as the material provided, the items in the consent agenda at present, I'm supportive of approval on those. So you all know that. So thank you.
Okay, I'll just continue on. This is a look at our general use operating budget, specifically by just our state general fund dollars, as well as our tuition budget that we established last summer. What we look at here is relative to our state general fund total appropriation. How have we been spending that relative to that point in time and year? You'll notice most of them are falling within that 40 to 50% range back to the December timeframe. A couple of them that you might look at, that capital renewal one, that 10.4 million, that's our one-to-one match. That one is only about 2% spent. Currently it's at 8%. We do have all of our projects identified. It's just getting through that construction process and getting the contracts let. That's what's leading to sort of that delay in spend. We just candidly, we likely will not get it all physically spent, but we do have the appropriation authority to carry that forward, which we need since we will have obligated all those dollars at that point. I'll skip then. This is again just a look at pure expenditures in comparison to how we categorize them by activity. Again, we're still hovering within that 50% range in terms of how we're spending our dollars. for that year. A better one to look at might be an operating expense trend on the next slide. So it's a 5-year trend you kind of look at to see how has K-State's total expenditures. So state dollars, tuition dollars, federal dollars, housing and dining dollars, how those are sort of all aggregated together and how we're spending in comparison to prior years. 2021, obviously being the pandemic, we saw a lot of constriction of activity. Now in 2022, we've come out of that pandemic. You're starting to see a lot more activity. If you look specifically at that research line, you'll see a big jump. That's because we're again back in full production as best we can. In fact, pretty comparable to pre-pandemic in 2021. And then you'll notice on our scholarships and fellowships, we saw a big jump there in 2022. That's actually the result of a lot of the COVID funding that we received specifically for scholarships from our HERE and our GEAR funds. So you see a big jump occur in there, but that's the pandemic federal aid playing through into that fiscal year. Yeah.
Ethan, based on the previous presentation, are you comfortable with your debt
We're going to
load?
get there.
Okay,
We're going to get there. I'm going to talk to you about it. Yep. Yeah, go ahead. Sorry.
When will we see, will we see a significant reduction in operating expenses because of COVID money running out? What's over the next hill?
Yeah, so over the next hill, we do still have some of our HERE funds on the student side, that student aid side. We've actually, they gave us an extra year to spend. So we're spending the final amount of dollars for our additional aid that we're providing this year. But you're right, a lot of our institutional support dollars that came in are spent in 2022 or claimed in 2022. What gets a little difficult, this is an expense side on the HERE funding. We were allowed to claim that as lost revenue. So it comes in as a lost revenue calculation rather than an expense side showing. But we did have GEAR funds. We had a lot of other COVID relief dollars that came in that we've spent out by now.
Will we be seeing COVID relief dollars in the 23?
The only thing you would really see in 23 would be a little bit of the GEAR funds that we have deployed for scholarshiping, as well as some of the remaining HERE funds. So that would be about it at that point. Another way to look at our expenditures in a categorization or a bucket would be to what we're spending it on. So you can obviously understand universities are, their major resource is our people. So the bulk of our budget is dedicated to spending on our faculty, staff, employees. So about 62% of our operating budget from last year was for compensation and benefits. Next one, obviously, is just that other operating, all those other things that we have to buy as an institution to operate on a daily basis. Everyone loves this chart. I think it's the infamous scissor chart that kind of looks at the trend in our operating budget, general use budget, over time, adjusted for inflation. So the main story here is you look at the change in how the institutions have been funded over that period. Back to 2009, the bulk of our budget was funded by the state, so about 57%. In comparison, we had about a 43% of our budget on tuition. If you go back even further, the gap widens. You kind of see then our trend in enrollment, trend in tuition revenue has significantly declined, starting to recognize that fully in 2017, 2018, to where today, if you look at just how we set our 2023 budget, we're getting pretty close to parity between the two revenue sources. And partly because, again, continued enrollment decline, but because of the significant state funding dollars that we received this year in comparison to last year. So again, huge benefit for the institution in terms of how we're funding our general operating budget. This is just a quick snapshot of our principal debt outstanding. You kind of see it continues to decline from 21, 22, and then what we're planning for this fiscal year. We tried to break it out by type of debt that we have. So between the research, athletics, academic buildings, our infrastructure and energy conservation efforts, housing, and then some student life buildings. 2022, we actually, we will be paying off or have paid off our engineering bonds, our UEIA bonds. We will have paid those off to the tune of about 11 million, but we did incur additional debt to about 10 million for the Salina housing complex. So that was a quick change that sort of netted itself out. And the chart does not include the recent KSA bond issuance that we just completed and you guys approved last month. So we've got to update that chart yet for that. So Regent Dicus, more to your point, university debt burden. And to Jim's point earlier, what you look at there is we actually had a decrease. So our internal goal, our internal policy is to keep our debt burden ratio below 7%. We adopted that, I think, when the CFI measures were first discussed and talked about. Elaine, I don't know how long ago that was, but that was one of the recommendations, I believe, at the time. So that's our internal goal, is to keep that below 7%. So we're well within that range at the institution. When you look at 23, again, we paid off our engineering bonds, we added the Salina, but the positive news is Moody's and S&P just reaffirmed our ratings. So they've actually reaffirmed our approach to how our financials and our debt burden and policy. If you look at the composite financial, well, let me back up because I think, Jim, you also mentioned wanting to look at our debt coverage ratio, as well as our, what was the other one, Jim? Or did he? Oh, yeah. Yeah. So when I look at those against the metrics that, again, from the CFI perspective, we're well within those areas as well, when you look at the more detail. I'm going to restate what you said. So can you state it to me again? Or come to the mic.
Right. So in addition to a coverage ratio, which is more of an operating statement, having a balance sheet metric as well would be helpful to look at.
So when you look at the composite financial index, which is again that summary calculation of the different metrics within this exercise, you'll notice we declined from 6.2 last year to 5.42 this year. The main reason behind that is 2020 to 2021, we saw a big spike because of our endowment returns. The significant market increases that we saw, that wasn't unsustainable. So you're starting to see that level back out. Overall, we're still then within that overall healthy range of our CFI. We look to maybe give you some context about what that CFI means and how we've progressed over time, is to take a look at the next chart where we look back to 2018 to where we're at in 2022. You see we've actually increased our CFI over that period of time, which is actually a real strong indication of how we've been managing at the institution, especially in very tight fiscal times with our enrollment declining and everything else. So we've actually improved our health to the point where we're in that sort of range where we can really start thinking about how do we move forward as an institution, and look at making some strategic investments, again, aligned with our new strategic plan. Building off of what Doug presented last year or last month, some forward-looking observations in terms of what do we think are risk factors. It's going to be an enrollment trend and inflation, no surprise. So again, we're actively working on our strategic enrollment management initiatives to turn around our enrollment. We are seeing, like I mentioned, some increased activity in that area. The other one would be our student retention. activities. So we're really excited about the NIS funding that was recommended by the governor. If that can come through, that would really allow us to deploy some of those student success initiatives. State funding obviously is a key component of our operating budget. So again, continuing to advocate for the institutions for increased state funding. And then like we always do, we're going to be very conservative in our spend management and making sure that we are living within our means as an institution. And that's it.
Okay, thank you. Are there any questions, any other questions or comments from Regents?
I do.
Okay, Regent Winter.
How, tell us about the change in your cash reserves over the last, I don't know, 10 years. I see the change in spending and change in tuition dollars. What's happened with respect to your cash?
It will depend upon the component unit. So if you look at our housing component, which we review annually in November when we're looking at our rates, they were on track over a 10-year period to have a sustainable, healthy ending balance. However, the pandemic hit. They refunded a lot of their housing receipts due to sending students home. So that greatly impacted their cash balances that they have from their particular component unit perspective. So they're actively working to get back within and build those reserves up. If you look at other components of the institution, again, we're a very conservative institution, and we deploy and ask our units, our colleges to also be conservative in their spend. And so they've also, if you look at our general cash balances, they have improved over time. I could bring you some more detailed information if you're more interested in it.
I'm just going to ask if you could easily get us a chart showing the trend in cash reserves.
Yep.
And if that trend includes endowment money, I'd like to see that, but I'd also like to see it without that.
I would probably do it without.
Okay.
Just purely what the institution has.
And so, assuming that there has been a significant reduction in, well, not assuming, we know reduction in receipts and funds to spend, how have you avoided cash flow problems? I don't want to beat up on Emporia State because they've done a great job since their challenge, but they had a challenge. How have you avoided that kind of abrupt spending restrictions that they had?
So what I could bring in for you, Regent Winter, would be to look at how we've deployed budget cuts across the institution. So we have reduced budget, I think, every year for the last 7 years as we activate annually. So we've had annual budget reductions. We've had a couple one-time callbacks when tuition didn't come in quite at what we had projected. So we've been actively managing to the tune of about $65 million reduction in our anticipated revenues over that period of time. So we've been very conservative and managing to live within our means.
What's been the largest single item that has of spending that's been reduced to make up for that $65 million?
Again, if you look at the bulk of our budget, 62% of our total operating has been on people. And so that's where a lot of the reductions have come through natural attrition. We did have layoffs at the beginning of the pandemic for some of our staff, and layoffs. Yeah.
So I'll excuse myself by saying that you all are probably getting bored with my repetition about getting some better metrics. In the Emporia State University situation, I think a number of us got caught off guard with the extent and nature of the amount that had to be spent cut from cash. So I'm particularly interested. I think we're going to have some opportunity here between now and the retreat to figure out some additional reporting mechanisms to allow us a better early warning system.
Yeah.
So that we don't get caught flat-footed.
Sure.
But just so you know where I'm coming from.
Yep. Nope. Makes sense.
Okay. There are no other questions. Thank you very much for the presentation, and we'll move on to employee estate.
Okay. Werner was trying to show me how to use this, but I wasn't paying attention. So Werner, I might have to have you come up here and advance my slides for me. All right, here we go. Thank you for giving us this opportunity, and good morning. We're going to start with a look at where we are in our fiscal year 2023 budget compared to actual spend, which you'll find on slide 2. And so as Ethan pointed out, we're in that 45 to 50% range in terms of revenue receipted in. I think something that really skews this for us this year is the cash reserves that we budgeted, but we have not had to use yet, which we're glad since we're only halfway through the year. So the use of cash reserves would come into play more towards the end of the year. And these cash reserves are out of our tuition funds that we have managed to set aside over the last several years. So what you're looking at is just the state general fund and tuition. On the expense side, we are a little bit below our 50% mark, again at 50% of the year. This is about a traditional place where we are. Last year, I think we were around the 42% range as well. There's really no anomalies in this that we see. What you might look at and say, okay, you got scholarship budget and you've only spent 3% of it. Part of that is that not all of our scholarship expense is recorded until towards the end of the year when we're figuring out how much foundation funds will cover scholarships and how much of our general use budget will cover scholarships. So that's always off at this point in the year. And the other one that looks really weird, I'm sure to you, is a 1,900% increase in our auxiliary enterprises. And that is only due to the fact that we have to pay fringes off our federal work study money out of our general use. And our student wages did go up this year. And so it's a very small amount, but the percentage looks really odd.
You just better get rid of that line.
Yeah. Well, blend it in
Fix that
somewhere else.
problem.
Okay. What am I not doing right here? Well, seriously, Werner, come up here and stand by me. There we go. Oh, too far. Okay, this is the scissor chart as Ethan referred to it. Ours is not so much as scissors right now, but it does show you the trending in the state general fund, which is the black line, and our tuition spending is in the gold line. This chart is slightly distorted by the fact that in our state general fund, there is one-time money of over almost $5 million. So our operating grant really hangs right below 37 million for the current year that we're in. Additionally, the tuition of 29 million has the $6.5 million of reserve in it. And so our tuition receipts are what you saw on that slide 2, which is going to be around 23 million. So as you can tell, for the most part, our tuition receipts have been going down over the last several years, which we have been very aware of. The change, though, between 22 and 23 is not because we're bringing in more tuition receipts. And we'll talk about that a little bit later in my presentation, because this is the expenditure side. The next slide is the trend in our expenses for across 5 years. And so what you see here is a decline over the last 5 years in our spending with an uptick in 2021. And as Ethan referred to, probably we'll all have this little bit of blip because of the impact of the COVID dollars that we received. And a lot of that is in scholarships, and for us also in our physical plant operations and also in student services, which then we did not have in 2022. In 2022, we still would have some aid money, some scholarship dollars. And then when we are here before you next year, you will also see that going into 2023 as we just finished spending the student aid dollars this spring. Next slide. Again, as Ethan pointed out, it just is a pictorial view of where our money is spent. And for Emporia State, people are 63% of our budget. Depreciation is also noted here, which remember that is not a cash outlay. So that doesn't affect our cash balances, but does certainly affect what we show in terms of expenditures, and depreciation goes up each year. The next slide is a picture of our financial health. And while, yes, we have been talking about challenges more transparently this past year, we still feel like we are in a healthy position because we had been building up our reserves and also making cuts each year. But perhaps we've been doing that from a management perspective as opposed to a more progressive look long-term and a strategic perspective, which has definitely been brought to the fore in the last year to 15 months. But for the most part, our primary and viability reserve ratios remain constant, which means that we have sufficient net assets to satisfy debt. You will see quite a decline in the orange line, which is the net assets ratio. And this is driven in large part by the market of our endowment fund. So if you look at last year, we were precipitously high, and that was a very good market year. This year, as that has come down, that has really settled it out. And I look back at my comments last year and I made the comment, don't expect us to stay at that kind of a mark in the CFI because it will level itself back out. And so we are, as you can see, that's exactly what we've done. Also affecting these ratios again is our COVID receipts and expenditures over the last couple of years. Earlier, someone asked about debt burden, and we're going to talk about that also a little bit later here, as we should actually probably in the next slide. So this is a picture of ESU's debt. We currently have outstanding $36.6 million in bonds. You can see there, basically we have two main issuances left, but in 3 years, we will be paying off a housing issuance that we receipted in 2005, but refinanced in 2017 and wrapped into the new issuance when we built our new residence hall and remodeled Abigail. So we have a drop in our debt service 3 years from now. And then in another 5 years, our Memorial Union debt will be paid off. So by 2030, we will just have one debt issuance outstanding. And that is our most current debt issuance, again, on our new housing stock. Our debt burden, right now is at 4.3%. So it is well below the 7% threshold. It has ticked upwards over the last 10 years. Part of that is the new issuance of debt that we've done in 2010 and again in 2017. But it also, it has to do with the percentage of your total expenditures, and our expenditures has also gone down. So debt going up and expenditures going down is going to make that debt burden ratio go up, but it is still in a healthy range. And our debt coverage is a 2.49 coverage. Okay, now we're going to move into our tuition. Just some statistics on our rates. This is a chart that shows how we compare both to our designated and aspirational peers. And for the last couple of years, we have been at the bottom of that group in terms of what a student pays per credit hour for a full-time undergraduate student to come to Emporia State. So we feel like we've done a good job of staying in the marketplace and very competitive with our rates and deem ourselves a good value. In this set of peers, there are two, actually three, including Emporia State, that did not have any tuition or fee increases since last year, and the remaining 7 had increases. So West Texas, A&M, and South Dakota and Emporia State in this chart had no increases from the prior year. I'm going to thank Doug Ball and PSU. This is a sign of how we collaborate together. You saw this chart last month. The question was asked, so what do we look like closer to home with probably more truly our competitors? And so this is the same chart that you saw last month, and we are in the MIAA, and Emporia State is again on the lower end of tuition and fees charged by the MIAA schools. This is our fall head count by residency, and as you will hear probably across most of the schools, and you're well aware of that, we have continued to see a decline in our fall head count. We've had a couple little upticks over the last 10 years, but for the last several years, we have been declining, and most of that has been in our resident students, which would be our most of those are our on-campus students. You will see a little bit of an uptick since 2017 in our non-resident students, and even that fell off a little bit in 2022. But we're hoping that the request that you granted to us starting this fall, where we will be able to offer all out-of-state students the in-state rates, that we will see that level off or go back up again. We've also had just a slight uptick in our international students, and that's been due to some new programs we put in place in our music department and also in our School of Business. This is probably even a better pictorial of what we're seeing happen. Overall, our credit hour production has also gone down. For a while, our online enrollment, which is basically our graduate students, are a significant portion of that, was going upward, and even it has softened a little bit this year and leveled off. But as you can see, our on-campus enrollments have really been going downwards, and is what is really driving some of the tougher decisions that we're having to make. So these are all charts that you see across our presentations each year. And Regent Winter, I think you're the one who said, so what aren't we seeing in those numbers? And so I've added here just a couple of the same charts and the rest of the story that I'll try to tick through very quickly here. Earlier on slide 3, I made the comment that that was our spending out of SGF and for tuition. And for SGF, the revenue and spending are always going to be equal, not always on the tuition side. So what this is our revenue side of the tuition. And as you can see, it too tells that story of that downward trend. But in 2022, you would have seen a $21 million spend, and on here you see a $24 million revenue. So we purposefully reserved some of our spending last year by making we took over $4 million of cuts in 2022 and another $1 million of cuts in 2023. Purposefully, as we're watching what's happening and knowing the enrollment cliff is coming in the next couple of years, have purposefully been setting aside funds over the last half dozen years or so to try to offset some of this turnaround and hopefully going back in the right direction. But here you see that almost $37 million that really is the better picture of our operating grant without one-time funds. I thought it would be fun to take our component units out of our CFI and see what that does in terms of health. And while it is flatter, we're still in a healthy position without our foundation or without our Memorial Union. And the foundation is very much driven by the market rates because of how they invest their funds. And ours is really driven by our operations, our debt and our net operating revenue. And so what you see here is some of the same kinds of trajectories, but again, the COVID funding is creating that in 2021. That anomaly in 2018 is driven by the change in the federal law for Perkins loans, and that's also the year that we took on the debt for our new residence halls. But otherwise, we still remain in a healthy position even without the impact of primarily our foundation. This is another piece of the story that shows the impact of those declining enrollments, particularly our on-campus enrollments on our own cash reserves. And so to minimize burden on students and our own debt burden, when we were in a better cash position back in 2011, we chose to basically loan our Memorial Union $4 million when they were doing the renovation because our students were taking on the debt service payments for the bonds. And so the original agreement was a 10-year agreement. And as you can see, we got to 2019 and stalled out. And again, they're feeling the very same effects of our declining on-campus enrollments because they are funded by fees. The same with the black lines that represent an internal loan to our residence halls. This was in 2013 when we renovated Singular Trustler and chose not to go into the market and go into debt. We instead loaned them $5 million to come in and do renovations there. Again, a 10-year loan that got refinanced by them over a longer period of time and then has stalled out in the same time period as our Memorial Union due to declining enrollments. Technically, under both of those internal loan agreements, what you would see in 2022 is no debt. So we used our cash reserves, 9 million of it, starting 10 years ago, to reinvest in ourselves and not take on more burden in the marketplace or increase our expenditures. In July, at the board retreat, this is a graph that we showed you that basically showed in going into this year, we were going to be about 10 million higher in expenses, expected expenses across our entire budget than we projected to bring in revenues. And so we knew that going in, there were some very intentional decisions made. And as you've seen those play out on our campus over the last 7 to 8 months in particular, some of that was really investing in making some changes so that we could be better positioned as we are going into the environment of continually shrinking enrollments to be more competitive in the marketplace and optimize the use of our resources. And so we've spelled out a little bit there along the right side what that gap means. And a lot of it's around our academic program review and optimizing our resources there, recruiting and getting into new markets and investing there. It also shows that our auxiliaries going in, again, influenced by our declining on-campus enrollments, was going to be underwater a little over $1 million. And those are playing out pretty close to the mark at this point of the year. Deeper dive into our enrollments. We looked over the last 20 years and we've picked out some choice years where we had some peak enrollments. And one of those is in the fall of 2010. And as you can see, we've really parceled out what's on campus, what's off campus, and then overall. Because if you look at our overall bottom line over the last 16 years, yes, 17% or almost 19% is a tremendous decline, but it's mitigated by the mix here. And for Emporia State, mix is extremely important to us. So while our off campus has grown, over that period of time by a little under 70%. Look what our on-campus has done. It's fallen by about 44%, and that is our bread and butter. That is our mission as a regional institution, and that's where our revenue is driven by, as those full-time students. Now, this is headcount. Unfortunately, FTE has seen a similar drop, but not as precipitously as our headcount. And so that means still there's more of our students, our on-campus students that are taking a full load versus a few credit hours, which is what you get in your online and on our graduate programs are those lower credit hour, and the fact that we have some special program pricing in there with our accelerated programs that just can't generate the same amount of revenue per student as what our on-campus face-to-face students bring in the door. So looking ahead, we are staying focused on our future. We know we have risks, and a lot of them, probably you could put any institution's name at the top of this, and it would be very similar in terms of the enrollment declines. For us, our on-campus enrollment is a key driver. Annual inflation, and then as we are having to start to rely on our cash reserves to smooth things out as we are making some strategic changes in our programming that we hope will pay off over the next several of years, going upstream as enrollments are going downstream. It will be an upward climb for sure. How are we mitigating our risk? Strategic enrollment management investments, and you see a couple of them there. More intensive and intrusive program review that we have been doing over the last year to really focus on those programs that meet Kansas workforce shortages that our students want, that we can attract more students. We're realigning our resources as well as right sizing our overall institution. We are strengthening partnerships and seeking more investments from our county, our city, and our ESU Foundation. And as President Hush has built out a broader leadership team, having that knowledge and transparency more far and wide, and also taking a look at how we do succession planning across the campus, but particularly in key roles so that we can ensure our business continuity going into the future. So while we've efficiently managed resources, I feel like over the last, well, I would like to say we've always efficiently managed our resources, but perhaps we're looking at it very differently. We're not just managing anymore. We are really doing more planning, going from a 1-year approach to that longer look out 3 years. But I feel that we are on a good path. And while next year I may not stand here and say everything is rosy, I certainly hope that we can say that things are improving. So with that, I'll stand for questions.
Okay, thank you very much. Questions?
Regent Winter.
Okay, did you want to go ahead?
First of all, let me compliment you and your colleagues for the tremendous work, difficult, courageous, and effective work that you've had to do the last 18 months to manage the enrollment declines, and most importantly, the revenue cash flow declines. Been very impressed with that. And I think it's obvious that you're reacting to it with better metrics here. Let me ask you this. To what extent, you've got a budget, right?
Sir.
And do you have a budget projection for the next year and the year after that? How far does your budget projection go in the out years?
We're really focusing right now on this year, and then we've got budgets semi-built out for 24 and 25. I'm sorry, I should be here at the mic. So at least 2 more years out, including the current year.
And is that something new that you were doing all along, or?
We have been gradually moving that way, but we have been much more concerted in our efforts in this last budget cycle and really taking what we knew we had to build in and how we were going to sustain that over the next couple of years.
Do you have, so you have a budget, do you develop alternative budgets?
We do worst case,
Worst case, best case?
best case, and
med-
expected
program?
case. Yes, sir.
And what do those look like? The worst case? You then, let me put a little more meat on that bone.
Yes,
Do you
please.
have specifics with respect to that worst case budget about what you'll do? Where will the spending cuts come from? Or are you leaving that for
We are really trying to focus on the expected case and put our energies into that. Yes, we built out a worst case, but have we really talked about what that means yet? Not necessarily, but those discussions are underway as we've been making some of the changes we've been making this year. And we'll
Right.
see how that plays out.
I think the President Hush and you all are well advised to focus on the positive and focus on things that are actually going to bring more revenue in and so on and so forth. I would encourage you, though, to not assume that that's going to be you're going to win there. So
Absolutely.
please be sure that you aren't caught flat-footed if those revenues drop off.
Absolutely.
Thank you.
Okay. All right, thank you very much.
Thank you.
Okay, moving on so that we can get our agenda work completed here in time. So we'll go to KU.
Thank you, Regents. I will try to go through this. I thought I saw it up relatively quickly. It's consistent with what you've heard from the other universities as well. And I'll tell you where we're maybe a little bit different. Being larger and often research focused, we have some things that are different, but many things are the same. I'm going to walk you quickly through the KU structure because we're going to be talking about the medical center as well as the Lawrence Edwards campus. Give you a little bit mid-year updates of those, our enrollment, where that looks at and how that's doing. And you'll see this year, current year, it's our second highest enrollment we've ever had. And it's looking positive for next year. And I'll talk a little bit about that. Our educational costs, our tuition and fee peer comparisons, give you a little bit of a general budget update. And then talk about the debt service, which is obviously a topic, and where our CFI is and how we're looking at debt. I know Regent Dykes, you had asked a question about that. I'll show you how our policy works on that and walk you through that fairly quickly. This is just to remind you, we're really two agencies, the Lawrence Edwards campus and the medical center. And the medical center is highly integrated with the health system. So it's it's a very complicated operational and financial picture. And you'll see under the Lawrence campus, we have a Center for Research, the Memorial Union, and Kansas Athletics. And the medical center has the research institution on their side, their health partners and their student union. And then we have our other entities such as KU Endowment, the health system, and the University of Kansas Physicians. So there's a lot of that's all combined in that we look at and keep and monitor all those separately and together. Kind of the mid-year updates for the Lawrence campus. Again, it's second highest freshman class ever. The other time was 2008, so 4,362. And our current trends based upon, as Ethan talked about earlier, housing deposits and applications, could even be higher than that number in the coming year. But that's the wild card across the country, is trying to figure out what enrollment's going to be, because it's up so much. It doesn't actually always make sense because people are putting in multiple applications. But looking at deposits, we're anticipating even higher enrollment next year. The general use budget and 5-year, the general use budget is managed through a 5-year financial plan that we instituted a couple of years ago. And we do that to manage our cash, manage our expenses. We have a structural deficit a couple of years ago of 50 million. We're down to probably 15 million on that now as we've worked through some of those challenges. And we're using a strategy of using our cash while our initiatives go into place to soft land and not crash. And so that's monitored monthly and quarterly. And we're going to be updating the general campus in a major update of that in the coming weeks that you'll see from us. We also have reserve policies of how we manage our reserves from our affiliates and auxiliaries to our general campus of what reserve levels we keep, and we manage that in our financial planning process. We have a major campus master plan that's coming out early this summer that has significant improvements to it in terms of how we monitor all our assets, that will go to a whole nother level. And we'll probably talk about that in the coming months as well. And we have a new state-of-the-art welcome center that if you are on the Lawrence campus, it is mind-blowing, 21st century welcome center. If we can get a kid in there, we're probably going to get them. So I try to get every person that's
on the street to go to the Welcome Center. So they want to send their kid there. So it's really a cool place to visit. When you come to our campus, we'd be glad to take you through that. Medical campus enrollment remains steady. The research enterprise continues strong growth, really strong growth. They're really kind of knocking it out of the park with the cancer center and other things that are going there. They got a new Wichita Center, the Cancer Center, brain health building plans and development. And they've actually done a lot of things to work more closely with the health system. For example, David Ranikar is here. Their CIO is now chaired between the health system and the medical center, which brings IT efficiencies between the two of them and other things like that. So there's some things going on there. When you look at our overall enrollment, it's been stable since 2020. Obviously, we took a hit from COVID. We stayed flat. And the issue is our freshman class is at a record level, but we're carrying that, we call it the COVID class through, which is a lot smaller. And the class that just graduated just recently was a very big class. So we're kind of holding our own with even with the big freshman class. As you can see on this slide, our freshman classes went up, but we're still feeling the effects of COVID on enrollment. And if we get the level of enrollment we're expecting next year, that starts taking us off to some growth, which will help us with a lot of the challenges that we're working through. Student credit hours have been relatively flat. As you go through, you can see the huge online change from the middle of COVID to today. One of our major initiatives is what's called Jayhawk Global, is expanding our online presence across the country in those areas that we perform well and have really good programs on. That is rolling out as we speak and is a major initiative of our strategic plan is Jayhawk Global and expanding in that area as well across the country. The famous scissor chart you've seen several times now, and this just shows you, how tuition is more. We're more reliant on tuition than we used to be. We're starting to pinch together. Hopefully, the governor's budget passes, and we can pinch a little bit closer. But we're still not remotely where we were many years ago when most of the funding was state funding. Tuition is a major component of both of our campuses in terms of that. In terms of our peers, with tuition being held to zero for the last 4 years, we've moved down that chart. And so you can now see we're kind of in the lower part of the chart in terms of comparing ourselves. On this is the Lawrence Edwards campus predominantly. You can see we're now down toward the bottom relative to our peers. We've fallen in our ranks in a good way because we've held tuition constant. Not all of them have. This is just a quick picture. Everything here looks normal as expected on the Lawrence and Medical Center campus, where revenues are running where we expect. Our expenses on utilities and things like that are running higher, but overall in general, we're below 50% through 6 months. So this is exactly where we would hope to be at this point of the year. On the Lawrence campus Medical Center, same thing. Revenues are running a little bit ahead, our expenses a little bit lower, but timing is, when you show these charts and you see these every year, timing, some things get paid all at once, some things get paid equally over the year. This just shows you that we're right on track where we expect to be for our expenses. This is the 5-year look in terms of where we are in all our categories. During this period, roughly this period, KU Lawrence Edwards has cut $97 million, largely FTE reductions in tenured faculty, non-tenured faculty, and staff. They're fairly significant. And there's a chart that I think that you got a while ago we gave out. It shows you kind of an infographic summary of what's been going on. You can see 12% drop in tenure track faculty during that period, 21.7% in other faculty, and a 9.6% decrease in staff. But the staff number is 328. It's the biggest number of drops. So you'll see now what I would say to you as you're looking at all these for all of us, and this is every university in the country is struggling with this. 20 and 21 aren't normal. They got COVID money in there. They got COVID expenses in there. 22 is starting to get normal. The year we're in now is what really normal probably more looks like. So when you're looking at financials of any higher ed institution, 2021 and 22 have COVID money. We've received $115 million of federal COVID funding, HERF 1, 2, and 3 during that period. The expenses are in there. So it's really hard to see trends looking at the last 3 years because of the impact of the pandemic on there. But we monitor closely. We've normalized it. We have in our plan of how we're going to manage that. This is the same picture you see for everyone else. Around 64% of our expenses are people. And so when we've had to do reductions and things like that, that's where the hit have taken over the last several years as we've had, you saw the enrollment drops were flat, which is good, and we're trying to grow back. And when you're looking for efficiencies and things like that aren't people, you only have the yellow slice to work on. And so that's the area that we're focusing a lot on in terms of procurement and other things as we implement our strategic plan to get to a soft landing. But you can see it's always people, and that's the way it is for everyone. We have a policy of no more than 7% of our expenditures going to debt service. We tell the rating agencies that's our policy. It's what we're rated on, and all the other metrics. Our financial plan actually has built in the Moody metrics. So when we do something in the financial plan, we can see what the Moody's metrics do, what our CDFI looks like, and what our percent looks like. So we monitor that as even in our planning of where this would go. You can see we're just a little over 5. Our cap is 7, and we manage our facilities and our planned borrowing on that 7% cap. This is our CFI score. And as everyone else said, you see it jump way up because endowment had such high returns, and you see it drop because there were losses in 2022 on the endowment side. That's the main driver that makes that chart. But we're when you look at us all together, Medical Center, Lawrence, and endowment, we have a strong index. The area that in 2017, you'll see the big jump that happened there. That's a lot of things happened at the Medical Center. And there's a lot of things going on at Lawrence that we hope to make that stronger in the coming years as we get our financial plan balance going. And then back to the things you heard from everyone else. And I think these will probably be topics at the breakfast we're having with you all tomorrow, or at least we hope to discuss some of these. Is inflation is a big hit on us, particularly on the water and sewer in the city of Lawrence anyway. And on the gas side, you say really high increases in gas costs and things like that. Faculty and staff recruitment and retention, we are doing a major market pay study to try to understand where we are and what we need to do in our financial planning to get market pay to maintain high quality staff and keep them there. Enrollment trends, there's, as everyone's mentioned several times, there's the quote demographic cliff in 2025. So our whole strategic plan is about how do you manage that, because you might be going up in the short term, but what's going to happen when the demographics catch up with you in 25? Facility upgrades and maintenance across all campuses, cybersecurity threats, and rapidly changing IT market. We have a lot of initiatives going on in that, from recovery centers to penetration testing to cyber insurance to sharing information between the two campuses and how we operate to minimize our threats. And again, some of those mitigations are enrollment management initiative. That's a very big one. We meet nearly weekly on our strategic enrollment management and our GHL Global student success initiatives to improve retention. Because if you can improve retention, that's almost sometimes as good as increasing enrollment, sometimes better. So that's a major effort of ours. We have a continuous improvement initiative to increase efficiencies across the campus that allows employee ideas to come forward. And I could get into that at some point in more detail. Market-based pay initiative, again, for faculty and staff. Targeting our investments in research and education. We have the need our research is expanding, and we have the need for facilities there. It's not that we don't have the space, it's that we have the quality that we need. So there's a lot of effort going into looking at how we're going to maintain those facilities. And then increasing efficiencies, again, between the health system and IT. They have this single CIO. That's never happened before, where they share one CIO across the medical center and the health system, which is really having a lot of positive impacts, and it's helping us in terms of collaborating with them as well. So those are the things that we're working on. Again, all of our efforts are in a 5-year strategic plan where we're looking at all the things we need to do and how we're using our cash, making sure we have the right reserves, all those types of things to thrive in the future, not just survive. So our issue is trying to find a way to get to the point where we can grow, where we can expand our research, where we can do all improve our facilities. And that is, and a big one is competitive market pay. That is a big one that we're spending a lot of effort on right now of how to do that and how to fund that going forward. So that is our picture for mid-year, and I'm open for any questions.
Okay, thank you, Jeff. Any questions? from members of the Board of Regents?
Chair, I'll try to keep this limited. So you have a 5-year projection? Is that a budget and revenue and expense projection?
Yes.
2 years ago, was that happening?
That started, I've been here 2 years this week, so. We
Okay,
started
to
at 2
say
years
you
ago.
started it. That's the case.
Yeah.
Do you have a graph that shows cumulatively the last 5 years or so, what I would call deficit spending, and that is expenditures exceed revenues? And then my next question related to that is, you have a graph on those reserves. What's that done with respect to cash reserves?
So what I could show you, and we have the plan mostly updated, assuming the governor's budget passed. You'll see so we took the COVID resources we got and the budget cuts that we took, and we tried to develop the liquidity that we can burn down while these initiatives come in place, but never going below our reserve policies minimum levels. So you'll see in our financial plan, the cash actually going down, but never going below a level and then coming back up as the initiatives come on place. So
That's something that's available that you can send.
yeah, we can show you last year's. It shows the same picture. We're updating that. We're essentially burning through the extra cash we have to land while these initiatives kick in, because strategic enrollment management doesn't happen overnight. Continuous improvement doesn't happen overnight. Conferences and events does not happen overnight. You have to do that over time. And the plan is to have those initiate before you burn to the level. And that's how our plan's developed. We're using our reserves strategically. We're using the money we got from the federal government strategically. We're planning our timing and how we're doing these initiatives strategically, so that when we come out of that, we can then start affording competitive market pay and other things like that. But yeah, we can show that too.
Thank you.
Okay, any other questions? All right, thank you, Jeff. So we're going to delay the Fort Hays presentation until our next month's meeting. And we will go to the items that we have on the agenda. We have items that are on the agenda today that are on consent that we discussed on the call. Are there any questions on any of those items? Okay. All right, Elaine, I'll turn it to you for anything else that we need to cover. Anything else you had planned for Regent ICE that you wanted to make sure we touch base?
Thank you. Thank you, Madam Chair. I think we have concluded our business. I'm incorrect. There, Regents, in front of you, and part of this month's agenda is just a reminder of where we are on our committee's work plan. So in front of you, Regent Dicus and Winter, you have a hard copy of that just to demonstrate we are doing our job and doing what we're supposed to do. And we have no audits for this month, and Regent Bristow can forego his update this month. And then I think we're done. And just a notation that next month we will meet at Pittsburgh State.
Okay. All right. With that, then we will adjourn, and Fort Hays, we will start with you with the reports next month.
Thank you.
Okay, thank you.
Now you know what Ethan felt.